My name is Eric. I'm our Chief Revenue Officer here at NEO and your host for today's NEO Presents. Welcome to this, our latest installment, Rise of the SPAC. Thank you for joining us over your lunch break on one of the finest days in November that I can remember. Perhaps before we get started, I'd like to take a quick moment to thank those of you who helped bring us together today, to our sponsors, Baker McKenzie, BLG, Blake's, Denton's, Goodman's, Miller Thompson, Stikeman Elliott, Wildeboer DeLeese, and Odyssey Trust. We're very grateful for your support in bringing such a diverse and tremendous crowd together today. Thank you. To the main event. I'm thrilled to welcome a very esteemed group to our digital corner of the internet today to discuss SPACs. No, I didn't just cough and choke my words. We're talking about special purpose acquisition corporations or blank check companies. These are all the rage these days with some real momentum behind them. In the US from 2009 to now, nearly 400 in total have IPO'd and nearly half of them have done so in 2020 alone. This year isn't over yet, dozens more en route, and I'm sure you'll see some more before the year is over. In Canada, far fewer by comparison, but some very interesting deals done and yet more to come for this new pathway to take private companies public. You've seen everybody getting into them, something you'd expect, hedge funds, bankers, private equity, and perhaps some you wouldn't, celebrities, TV personalities, and even politicians. Your favorite company may have been the result of a SPAC. Names that come to mind, DraftKings, Virgin Galactic, and Nikola, the Tesla electric car competitor, all going public by SPACs in the US. Pioneered almost 30 years ago by EarlyBirdCapital in the US, SPACs are dominating headlines. The upward trend in popularity has found its way north of the border too, and today's SPAC market in Canada continues to expand. Always at the forefront of innovation, NEO is the stock exchange of choice for SPAC listings in Canada, raising close to $2 billion in SPAC IPO money last year, including the largest SPAC IPO in Canadian history by a Subversive Capital Acquisition Corp, which raised almost 750 million Canadian in its IPO. There's also the first ever dual listed SPAC between NEO and NASDAQ by Merida Merger Corp. And today, I'm really pleased to introduce our esteemed panelists. We'll speak with key players in the US SPAC markets in particular to learn more about why these investment vehicles are so successful and how they can be leveraged to take private companies public. We'll discuss some real life experiences with a leading US SPAC sponsor, the largest company to go public in Canada through a SPAC, and the banker who invented SPACs, and of course, NEO, the Canadian SPAC exchange. With that, I'd like to introduce you to our moderator, whom perhaps needs no introduction, Catherine Murray, TV anchor with BNN Bell Media. Steven Levine, CEO and Head of Investment Banking at EarlyBirdCapital, who will also provide our keynote today. Michael Abbott, CEO and Head of Investment Banking, CEO, co-founder and Executive Chairman at Columbia Care, and a NEO-listed public company that resulted from a SPAC, actually one of our largest SPACs exits in Canada, if I'm not mistaken. And Joe Crouthers, Chairman and CEO of Ceres Acquisition Corp, a team still in SPAC form, and our most recent SPAC listing on NEO. And of course, NEO's very own Jos Schmitt, President and CEO, home of a number of SPACs in market today with substantial assets raised in SPAC form looking for deals. So you've got a very well-rounded group of participants here in front of you. Maybe one housekeeping item. You've got an impressive roster, as I said. I encourage you, ask questions throughout, leveraging the chat box on your screen. Catherine, our moderator, will work those questions into the dialogue as we move through. With that, let's get straight into it, shall we? Steven, handing the stage over to you for the keynote.
Thank you very much, Eric, and good afternoon, everybody. My name is Steve Levine. I am a co-founder and CEO of EarlyBirdCapital. As Eric said, I run the investment banking department. The history of SPAC. So I'll give you a brief overview of the background, and then we can get into some more of the data to bring you up to speed and where the market is today. We created the SPAC vehicle in the 90s, really to address the exit from the market of what we used to term the four horsemen underwriters. That was where H&Q, Robbie Stevens, Alex Brown, Montgomery, the investment banks that did offerings for the emerging growth businesses of that era. So in the late 90s, as you recall, the markets in the U.S. became very robust. The large banks were underwriting early stage businesses, and that evolved and that evolved. And then these banks that were the four horsemen I just described, they exited the market. They were either sold or they moved up market, and it created a void in the marketplace. And that's what drove us to introduce the SPAC. And in 2003, we underwrote the first SPAC of the new millennium. We had been underwriting SPACs in the 90s. There were 14 done in the 90s. But we reintroduced the SPAC in the new millennium in 2003. And if you look historically at the numbers, and if you wouldn't mind going to the next slide, you will see that in 2004, where we were the only underwriter in the business at that point, we underwrote 12 SPACs. Their average size was $35 million, and we raised a total of $480 million. Fast forward to today, in 2020, there's been 170 SPACs underwritten in 1 year, raising in excess of $62 billion. It looks as though the market will top at about $70 billion for the year, and will be absolutely setting all-time records. There are a lot of iterations and a lot of drivers to that growth. You can look through the years. Obviously, there was early growth, and it was adopted by a broader segment of the market. If you look at today, then we had a recession in 2008 when there was a pause, and then it started to grow, and it's continued to grow ever since. And there was a couple of interesting items that you should note. As you see the growth in the market, you also see the growth in the pipe market. These are all driven by the entrance into the space. So as the market grew and as more and more people became familiar and adopted the product, you could see that it was replacing. It used to be the number 3 or number 4 choice for a company seeking funding. They would either go public the traditional way, they would seek a strategic, they might do a private placement of sorts, and their last approach would be to go public or access capital markets to a SPAC. Today, I believe it's the number 1 choice. Since 2017, SPACs account for 40% of all IPO proceeds, and that's going up on each year as a higher percentage. And the reason is there's a lot of benefits to the SPAC approach versus the traditional IPO approach. And from a target standpoint, from a company going public standpoint, they've become more and more important. Number 1, first and foremost, there's a value add to the capital, which is typically through the sponsor group. The sponsor entity that sponsored the SPAC is typically value add to that target. Number 2, valuation. Valuation is much easier, much more definitive in a SPAC business combination than it is in an IPO. An IPO is sort of a black box where the underwriter tells you what a range of valuation will be and where you may or may not price. A SPAC is a negotiated valuation with your counterparty. And as you can see, and I'm talking about the pipe market, the pipe has become a method to validate that valuation and to offset the risk associated with a SPAC, which is the availability of capital at closing. So, Early Bird has underwritten 110 SPACs. We've raised north of $12 billion in our life. And in that process, you learn and you iterate the structure. It's fundamentally the same. There have been tweaks and changes to make it more user-friendly. But in essence, what you're doing is you're raising capital and you are approaching a target, you're negotiating a valuation. You are then taking that to the marketplace. Now, you're taking it to the marketplace through a private placement pipe, validates the valuation, also gets the capital committed that you're looking for in the transaction. And then you're announcing that transaction publicly and going to vote. So it's become a much more sophisticated product, a much more user-friendly product. And with the entry of the private equity firms, it has elevated both the stature of the sponsor group as well as the quality of the target to a level that competes with and maybe even surpasses the IPO market. Because if you look at the targets, some of which were mentioned. They're all capable of going public through the traditional method. You look at a bunch of the EV businesses that have gone public through SPACs. They've raised probably 10 or $12 billion in SPAC structure. And you're looking at a pipeline of transactions that we're aware of or that have been announced and haven't closed that are also of that caliber. So, it's become, in my opinion, I say it's disintermediating the traditional investment banking process, and it's creating a direct counterparty that you negotiate valuation with and go to market with. So in essence, we're at a point in the market where the SPACs are going to be a staple. There's no way they're not a mainstream product now. They will remain a significant part of the capital markets formation, both in the U.S. and as was discussed by Eric, and the Canadian market, and now the European market and the Latin American market. So it is becoming a global product, and we're very excited at the prospects. So with that, I'll turn it back to you, Eric.
Thank you, Steven, and incredible data and insight. And, I agree. Ultimately, I hope an indicator of what's to come as the market continues to identify unique options and provide competition and choice for companies seeking a public exit. With that, I think it's high time. We've got a very esteemed group around us now. I'd like to move us to the main event. Catherine, I'll turn it over to you from here to moderate our panel.
Thank you very much. A lot to follow up on for sure. Joe, let me start with you though, in terms of being the sponsor of a SPAC. What were the decisions that you came up with in terms of going that route versus the more traditional capital markets way?
Yeah, look, I think a lot of the things Steven just said, right? I think for us, specific to cannabis, we love the flexibility that the SPAC provides, namely bringing investors and companies together in sort of a more collegial way, where it's more of an M&A transaction versus, as Steven said, your advisor is essentially your adversary, sort of from day one, and working on those valuations. And I think versus a regular way IPO, specifically again in cannabis, there's a lot of features of the SPAC. Cannabis has capital constraints, right? This is another avenue, where you don't tend to see as many traditional way IPOs. This is an alternate route for companies that are prepared and ready for that move. And I think that again, the flexibility sort of allows an industry that's nascent and sort of evolving here, a way to sort of slide into comfort around public markets, and it allows investors to step in sort of slowly with that. What you always hear about a SPAC, right? A free look for the IPO buyers. I think that's a big feature here when you get into such a young industry as cannabis. Outside of cannabis, there's some of those same reasons. Obviously, don't maybe have the capital constraints, but you certainly have a lot of the other features of the SPAC. And again, to me, it always comes back to flexibility. You can work through that process. You can have a lot more vision into what is our valuation. It's more of a collaborative process, versus sitting across the table from each other adversarial setup.
Michael, let me ask you to pick up on that point because, when we think about the capital markets and it's interesting, Joe, I think you worked at Goldman. Michael, you did as well. So did I. I mean, we're capital markets people by nature. So Michael, if you could give us a little bit more detail in terms of perhaps what it's really like to go the SPAC route versus using your investment bankers, which, in many ways are supposed to be on your side as it relates to the client base that you're going to be targeting and how much money to raise and quite frankly, the right price, which is, seems to be a little bit of a question mark here versus the transparency perhaps that the SPAC gives.
Sure. So why do you go public? You go public because you want a permanent capital base. And as a private company, you're likely to have a lower valuation than if you're a public company because you're liquid versus private where you're illiquid. As Joe mentioned, cannabis has restrictions on who can invest directly. But I think if we look back at our timing, the biggest issue for us was speed to market. It was also listing on an exchange, which was a senior exchange and not a penny stock exchange. So that's why we chose NEO. So there's a little plug for you there, Jos. But I mean that very sincerely. I think they're all the pluses: speed to market, being able to, in our industry, access capital at a price which is going to be greater than your private market valuation. The negatives, you pay for it because there is a promote. That is typically going to be greater than perhaps you would pay in fees to an investment bank. You also, and I think we found this during when COVID hit this year and when we conducted a debt financing, what we realized was that we did not actually know our investors as well as perhaps we would have done were we to have gone through a long form IPO process, which wasn't available to us necessarily. And what do I mean by that? If you go public through long form IPO, you spend literally months on the road marketing to institutional investors. You get to know them incredibly well. And so when you go through a period of financing, you can reach right back out to them. I remember the day when we actually made a decision at the board to go public through the SPAC. And within 48 hours, we'd raised our money, we'd made the decision. It was a very quick negotiation. It was very, very pain-free. But we had a list of, I think, 100 investors, and I barely knew 5% of them, and nor did my partner, Nick. So that's the downside. You have to rebuild that. You have to understand it. And then the last point I'd make is that you have to be ready to be a public company. There's no panacea here. You can't suddenly go from private to public and expect that running a private company is like running a public company. It's not. It's very, very different. Exchange rules, securities law rules are entirely different. So the amount of work that you actually have to put in between making the decision and actually going public is very intense. I don't know if it's as intense as going public long form. It's probably shorter, but it's still a great deal of work nevertheless.
Steven, maybe you could weigh in a little bit on that in the sense that, when we look at so many industries right now in the public markets that have really had the step change function because of COVID-19, would you echo the same for the SPAC market because of the inability to almost do these 2-week, 3-week road shows, that it's really had a pull forward effect? And if that's the case, do you think that will be sustainable?
Yeah, it definitely has been a shift in the IPO process across all markets, and SPACs included. The roadshow is Zoom. It's this. We'll typically run the same amount of time. It's more convenient because you don't have the time change and travel issues that you may have to cope with logistically when you do a traditional roadshow. But and you may lack a little bit of the chemistry you create when you're sitting across the table from someone, but I think it's been a very effective method, and I think it will carry on in the future. It's clear that investors are comfortable with it. It opens up a broader day for everyone, so you're able to see more clients. And I would take a little bit of exception to what Mike said, only in that done well, when you do the second part of a SPAC transaction and you're de-SPACing, you should be seeing not only all or meeting all of your original investor base, all the people that invested in the IPO, but dozens of others who in the course of this transaction you're trying to entice to take a position in the security. So I think that a typical SPAC roadshow is much more intense, much longer, and much broader than you would see in a traditional IPO.
Jos, let me ask you from a competitive perspective, as we look at what's occurred in the United States and perhaps bring that more towards the Canadian market, what is your offering in the sense that how are you going to be competitive? What is the value add that you are bringing to potential sponsors and SPAC players?
Yeah, it's a good question. And I think that the first element that I would probably put forward is, believe it or not, experience. So we have now seen 8 SPACs that listed on NEO. 2 of them had a qualifying transaction. 6 are in waiting or working on targets, including Ceres Acquisition Corporation with Joe. What we see is that whether it is a SPAC doing a qualifying transaction, whether it's an IPO, company has to realize that going public is like setting up a new business line, and you need to put money aside to invest in that. You need to put in place the right external help to reach out to investors, to reach out to all types of investors, only institutional, retail, particularly true in a market like this market, where retail is still be present. Reach out to financial advisors, and those are kinds of elements that we build experience in, but also are really helping with. So we help organizations that to understand what it takes. I think that's an important element of differentiation. The second that I think, and that is more an element, when we look at this vehicle, we think it's a great vehicle for transactions that lead to larger listings. Mag's company, we're talking here about a billion plus company that is listed now on a public exchange. I think there's also a need to have some vehicles that are going to address the needs for what I would more call growth companies here in Canada.
Right. That is often one of the criticisms in the Canadian market, that there's just not enough risk capital out there. Joe, from your perspective, though, how difficult or easy, perhaps, in this market was it to raise money? And what's the thought in terms of finding targets as well? Is that difficult with more money chasing fewer opportunities, or is it the reverse?
Yeah, I think on the first question, I wouldn't say it was difficult to raise money. I think a lot of that does come down to what you went in with, right? If just like any investment, right? Folks are looking at this. It obviously has, again, it has sort of that free look feature, so there's a little less risk for them in that original purchase. But I still think, look, investors are still looking for a plan that they can get behind, a team that they can get behind, and obviously cannabis, I think, has been helpful in terms of just how topical it has been and how much focus it's received. So that's been helpful. I think our underwriters were very helpful. Obviously, the network that they have and opening those doors throughout the process was very helpful. I think obviously the more SPACs there are, you could see it just being a little bit more competitive for those IPO buyers. And in terms of targets, look, I think there's been it's sort of a mix. Some folks are awake sort of to the opportunity that a SPAC provides their business and want to explore it. So we are getting some outreach directly to us saying, hey, we want to explore this. I think folks that are knowledgeable about it, can look at what are the features of your group, right? What are you bringing to the table? Steven mentioned this earlier. The value add from the team, I think, is important. And then sort of the structure of your deal, right? We were fortunate to do a half a warrant, and our sizing, I think, has been appealing to folks in cannabis. The large SPACs, in a small industry, obviously are just a little more limited in what they can do. Doesn't mean there's not plenty for them to do, but I think for us, that's led to some outreach to us as sort of our structure and the team that's behind it with us. And then the other piece for us is executing our strategy, right? So reaching out to the folks that we specifically have known and want to work with, and we've been investing in cannabis for the last 3 years, so a lot of these companies we're familiar with. So that's been very helpful in terms of our strategy and executing it.
Michael and Steven, I don't know if either one of you want to weigh in on any of those aspects, and also, of course, the importance of getting the structure right.
Yeah, look, I think those are all very good points. Structure is important. Size is more important. I think the growth in the size of SPACs is troubling in some respects, because I think it leaves a void again for businesses sub $500 million in value as to where they can go for funding. In the U.S., on the U.S. side of the border, this average SPAC reaching almost $400 million in size, in order to do a successful D-SPAC, probably needs a target worth somewhere north of $1.5 billion, which is a very, very competitive landscape. And it also creates and leaves those companies with a lower valuation with a harder time finding access to capital, which I think the SPAC will address. So in my opinion, but you'll see a whole new spate of SPACs being raised in the $100 to $200 million size and maybe even smaller. With the growth and robust market for PIPE capital raising, you can start with a smaller base in the IPO, which is less diluted, and then add on capital in a contemporaneous financing that will be able to achieve the same result as raising a larger SPAC without the risk associated with being in such a competitive market. When I run down, and I skipped a slide, I'm sorry, at the beginning of the average size of SPACs sector by sector, you'll see that they're all very large. And I think I'm getting calls daily from businesses looking to go public through SPACs, and there's just no SPACs small enough. So I think you'll see the next wave be in the smaller size rather than the larger size.
I think it's also worth mentioning here too, to tie what Steven and Michael said earlier, that the cost of a SPAC obviously is alleviated, if the sizing is appropriate, right? And if the deal size, that sort of dilution from those warrants, et cetera, that you hear is sort of a knock on SPACs, that with the appropriate sizing, you can take care of a lot of that and make it effective, very, very close to the same sort of cost profile of a traditional way IPO, if the deal versus the SPAC size, are sort of in that right ratio. I think that's an important point, because Mike's right. It could be an expensive vehicle, or it can be a very average priced vehicle versus other options.
Mike, can you weigh in on that experience for you in terms of getting that structure and size and pricing right, cost right?
Yeah, I'm probably not the best person to ask on this, because we, without any foresight, we happened to pick the absolute top of the market. We thought it was going to keep going, of course, but it didn't. And then there was a significant downdraft in all cannabis companies and the whole industry since we priced. And so there was, and nobody was spared. So in some ways, I suppose we, as a company, we made out very well, because we sold stock at the price that we did. I think the good news from an investor standpoint is to know that we still hold all our stock, all the executives and all the insiders, so that they should feel good about that we're not, we're still long term. But I'd love to just touch on two things which are related to your question, Catherine. One is just the explosion of the number of SPACs out there. It's obvious that, and this has been a point made by you, Steven, and you, Joe, the more SPACs that are out there, the more companies are going to shop themselves around to the best possible economic deal. And so, as an investor, if there are investors on this webinar looking at this, think about that. Think about who are the highest quality people. And I happen to believe that Steven and Joe are two of the highest quality people in the industry, just from knowing Steven and reading about Joe. Of course, you worked at Goldman, Joe, so you must be. I think the critical thing is, look around very, very carefully, because companies will shop around for the best possible deal. The other thing I would urge investors to think about is who's actually holding those SPAC shares. Something we didn't necessarily experience, but I know that perhaps others have, is that some people are actually just investing in the SPAC for the actual trade and to own the warrant and to sell everything day one. And not to be a long-term holder. And we've actually, we even determined that in the case of a couple of SPACs, there were certain people who ultimately did not have the charter to even own a cannabis company that was operating in the United States. It was not in their charter. They didn't have the facilities to consider those shares. And so it doesn't actually take much to pull up the holders. Anyone can do it. It's public information. And so just try to look through them and see who are the biggest holders, and try to understand whether they are, long-term investors in the industry that, this company is trying to de-SPAC into. If you do that, and if you're confident in it, I think it'll give you a better sense. For us, Catherine, it was, we did get some great long-term investors. We still have them. And our experience, I think, ultimately was a good one, because we achieved our goals.
Okay. Go ahead, Steven.
No, I just wanted to weigh in there, because this is a continuing conversation I have on a daily basis with every potential SPAC sponsor and every target that is talking to a company, talking to a SPAC. SPACs are the most democratic way to go public. that you can imagine. You have a stock trading at $10. You announce a transaction. It's a public announcement. Everyone knows the transaction. You file a proxy. In that proxy, you disclose everything about that business, everything that you would in a normal way IPO, as well as everything about the market. That proxy is on file, at least on the US side, that proxy is on file for 3 months. You have a long time to look at how that company is being traded, how it's being received. Analysts get a chance to look at the company, institutional investors, and there are a series of roadshows. If the stock trades at a price higher than someone can get to redeem their shares, there will be no redemptions. Whether he continues to own the stock or not, whether he's a placeholder or someone's only interested in yield, as Mike is pointing out, or not, is irrelevant. Because eventually, if it's priced higher, if it's trading higher than someone can get for redeeming his shares, whether it's Mike that owns the stock, Steve that owns the stock, Joe that owns the stock, or Catherine that owns the stock, it's irrelevant. What's relevant is you have the capital available for you to close your transaction. So that's the key dynamic. When someone goes into a SPAC, for instance, the SPAC that merged with, it says it's in the cannabis space. Well, I can tell you more than half the SPACs that are raised never do a deal in the space that they say they're going to do a deal in, because their charter allows them to do a deal in any space. So when you go out to raise the initial capital, it's very, very difficult to attract a cannabis-only investor or a fundamental investor in any sector who's a long-only investor to invest in a SPAC, because his charter and his mandate as a portfolio manager is to analyze a company, analyze a transaction, and then make a decision whether or not to invest. In a SPAC, he's abrogating that responsibility to a SPAC sponsor, which is not in his mandate and is not in his charter. So what you're going to is you're typically going to a hedge fund who may have a SPAC portfolio manager that has a portfolio of these stocks, and he's watching those announcements. He's watching how the deal's being received. He's seeing if there was a pipe done. He's seeing where it's trading. And if it's doing all those things in a positive way, he may call in his PM that manages that sector, his portfolio manager that manages that sector, into a meeting to look at the company, meet the management. If they like it, they'll move that position from the SPAC portfolio into the portfolio of the long-only portfolio manager. So it's really, you have to understand that going into this, you will have a recycling or replacement of a significant portion of your shareholders. One, because they're not necessarily owners long-term, as Mike points out. But two, it may be something they never thought you might do. You may start off in a sector in technology and then do something in industrials. You never know. Or for some other reason that they determine not to maintain their position. And you have to expect that. These portfolio managers, any portfolio manager is seeing 4, 5, 6 deals a week. He's not going to keep his position in 4 or 5, 6 companies. He's going to maybe choose one. He's going to maybe choose 1 out of 10, maybe choose 1 out of 20. And if you look at it statistically, that's what happens. You may have a 50% plus recycling effort to go through, but you will have some portion of investors who will remain in those transactions.
I have a couple of follow-up questions on that that I think are important, because Jos, I think that we've got a number of different types of people that have tuned in today. If you're an investor, if you're a family office, what then does your thinking need to be as it relates to investing in SPACs, in the sense that you think that the mandate is X, but it might be ABC? Is that just something that you have to understand? And then the other aspect, which is kind of interesting that you bring up, Steven, is that if there's a SPAC portfolio within a hedge fund, I'm hearing layers. When I hear layers, I hear fees. So can you address those 2 points in terms of how an investor, family offices should be thinking about this?
Well, okay. I'll start off with the sponsor's carried interest. The sponsor gets a 20% post-money carried interest in the vehicle. And as Joe pointed out earlier, if you do a correctly scaled transaction where the SPAC is maybe 1/3 or 1/4 the size of the enterprise value of your target, that 20% becomes something more like 6 or 7, which is very akin to a traditional way IPO. When you don't do that, you do end up with a high cost and a high dilutive impact of the carried interest. The fees, the overall expenses of a SPAC business combination are higher than a traditional IPO because you have two vehicles, each one with their own expenses. Whereas in a regular way IPO, you're only having the expenses of the issuer going public. Here you have two public entities. One has deferred fees to the underwriter of his initial IPO, plus his own legal fees, plus his own audit fees. And the target also brings their own legal fees, audit fees, and advisor fees. So you could end up with a high expense ratio in terms of just pure dollars. And that's just unavoidable for the product. It's just the way that the product is. I think Promote is becoming more flexible in terms of restructuring and even sacrificing. And we have what's going on in New York, in the US side, which is being called a SPAC off, like a bake off. Whereas, as I think it was Mike pointed out, in a competitive environment, companies are shopping SPACs and putting SPACs in a room and asking for what are you going to give up in order to get the transaction done. But ultimately, those things will come and go, depending upon the number of SPACs seeking targets. Right now, we're at a high point in history, and I think that will balance over time.
Michael, I'm just wondering if you could weigh in a little bit more in terms of what Jos was saying, given the fact that Columbia Care is one of the largest public companies listed in Canada resulting from a SPAC. Maybe talk a little bit about your experience versus really perhaps what the bad taste in the mouth was for a number of people a few years ago.
I think the answer to that is that there was such euphoria at the time that we went public with the cannabis industry, that euphoria, frankly, just suppressed any recent history or even medium-term history in the past about bad experiences, number one. And number two, I think there was definitely a bad institutional experience in Canada. I'm not sure if there was a bad retail experience, but we had a lot of retail people who were coming in to the SPAC, and a lot of people, retail people coming into the industry at the time that we did. So I don't think that history has erased itself. I just think that we happened to pick a good time because our industry was going through this sort of euphoric stage at that time.
If you were to go forward with another SPAC, or Steven, did you want to weigh in?
Yeah, I would say that Michael, is in a sector that has its unique, very unique issues and concerns. And he mentioned a few before about institutional investors that couldn't own cannabis stock. The exchanges won't list them in the US. So it's what gave rise to our doing a dual listed SPAC together with NEO and NASDAQ, so that we would be able to, if the company did end up doing a plant touching business, we could list NEO and we would always have the US listing as well. I think that's all correct. I think what Joe said was correct. I want to just address one question that came up. I don't know, a question from David Albo about whether we see single transaction, multiple transactions, or portfolios. It's almost always a single entity transaction. You can do multiples. We've done as many as 6 companies simultaneously. I will tell you that it's fraught with issues. You have the need for all of those companies to be compliant in so many ways, regulatorily and financially, audits, and management has to all work out. So I would avoid that at all costs. I would try to do a single transaction or 2 at most. Portfolios you don't do because you can't, at least on the US side, you can't have an investment thesis. That's not your business. You are merging your entity with that entity. You are not taking a stake in that entity where they're both separate. You have one security, and that security is owned by all stakeholders. So it's usually a one transaction.
Mm-hmm. Joe, when you think about looking for a target, that's one aspect. And then, of course, the next step of becoming public. What are you thinking of right now in terms of your planning process and the approach?
Yeah, look, it's as Steven was just saying, it's a little bit of an awkward walk down the line, right? Where your job obviously is to not have a plan when you form the SPAC, but obviously you wouldn't go down the path in the first place if you didn't have some ideas, right? That you thought you could capitalize on and see those opportunities. So, I think as we move forward through our process, awareness is a big deal. As we know, PR has been a big deal, especially in cannabis. There's a lot of, we need to change attitudes out there around how they view cannabis and those things. So there's a lot of PR to get some awareness on the name that you're working with. You can do the little things, right? Like, sort of being ahead of potentially getting a pipe secured, OTC listings. There's preparation you can be doing so that back to the liquidity question, you get the most, sort of the most beneficial setup that you can there, and make that liquidity as easy as possible. I think it's also a value add from the team. What can the team be doing strategically to be helpful to the business? At Ceres, our big focus early on was to bring in some partners that would help sort of buoy, if you will, some of the weaknesses in some cannabis stocks, right? Cannabis has trouble marketing its products to its consumers. So we brought in a marketing firm, an ad agency, to help sort of champion opening the funnel and getting us more access to consumers in creative ways. I think similarly, we brought in a couple of large talent management firms to be able to do some of that as well. So I think it's about value add, thinking about really looking at the transaction as this is a place to start a partnership versus this is the end of the line. And with us, that was sort of how our approaches work. So I think that's made it easier for us, to talk publicly about what we're doing, as we get further down the line, and hopefully creating just more awareness and and focus on the names that that we bring public through the SPAC.
And Jos, speaking of awareness, what kind of growth are you thinking about with respect to SPACs in Canada? Especially when you take a look at what's gone on in the States. I mean, how do you make even a good estimate or forecast?
I wish I could answer that question. That is like how many listings will we have at the end of next year? Look, I think it's an area of growth. I have no doubts in my mind about that. I think it has been thriving on the back of at this stage of the cannabis industry, and I think that what we're going to see in the coming months is SPACs in other industries. I think there are other industries that can be very interesting for this. If you look at Canada today, we have maybe one SPAC today that is not cannabis related, which is a technology SPAC, but all the other ones that are open today, so 7 of the 8, are one way or another related to cannabis. I hear rumblings, I hear party sponsors that are looking at the new vehicles, and what kind of emerges is some of the newer industries. So I hear a lot about esports. I hear even about psychedelics now as a new environment. Technology. I hear mining, which is quite interesting. The gold mining area. So there is really a lot of people thinking about it. And if I would take a wild guess, and remember, we are kind of more in an emerging stage here. And the numbers are fairly low, but I would expect that next year we're gonna double the numbers that we have today. But more critical, that is at least where we're gonna put all our attention with partners like Joe, that is making sure that the ones that are there today, when they do their qualifying transaction, that they are successful. And Joe gave a few thoughts about what he thinks about and how he's kind of preparing for when he's doing the de-SPAC. I think we all have to be all hands on deck to make that work, to make that successful, and then success is going to call for more. That is kind of what happened in the US in the last 3-4 years.
Yeah. Steven, maybe you can just address that as well from where you sit in the United States and looking at the Canadian market and the size right now, and maybe provide a little bit of advice in the sense that if we went back to the 1990s when SPACs were coming about, but then stalled perhaps a little bit, and even stalled from, it looks like 2009 through 2015. What are those lessons learned in terms of perhaps the communication, the marketing of SPACs, the quality, the teams? What are kind of some one-liners or bottom line for us to be thinking about here in Canada?
Right. Well, I mean, look, success breeds success. So, what changed the market in 2015, 16 in the US was really the entry of the private equity world into sponsoring SPACs and selling companies into SPACs. So the profile of both the business and the sponsor group was elevated dramatically. I think the issue in Canada, when you look at it from a sponsor's point of view, is you really have to know where you're going to go for your deals and the average enterprise value of those deals. And in Canada, I think you'll have an abundance of companies that may be on the smaller side. So when you think about using a public vehicle for that transaction, you need to think about access to research, liquidity, what investors are going to want, how are you going to attract institutional capital? You need those things to be in place. So I think that it's going to be a slow build. You're going to need successes to point to. I think Joe's going to have a great deal to do with that as he moves forward, and others who are going to list businesses there. It's not going to leapfrog. It's got to be a slow build, and you'll see if you can get institutional sponsors in Canada. You'll see that as that happens, there'll be more of the elements you need as a successful public company. This is not about, and Michael pointed out in the beginning, it's about companies that are public ready. Don't try to force a square peg in a round hole. SPAC is a useful tool in the right circumstances. It'll be a disaster in the wrong circumstances. The sponsor will lose his money. The product will get a bad name. And that's what happened early on in SPACs in the US. You need to sort of cultivate the right audience. In the targets, it's about education. You need to educate the investor community, educate the targets to what a SPAC is, educate the investors. And if you do that, and the investment banks, you need to get support on a research side and on continual roadshows, non-deal roadshows. You're a public company, and your goal is to maintain a presence in the public markets, as you know.
Michael, I know they're going to wrap it up here. Yes, go ahead, Jos.
One point that I would like to add to that, which is very, very interesting, and which is, a bit of a characteristic probably of the Canadian market. I think I mentioned earlier when I was a little bit harder to hear, I think, that a firm like Canaccord has been playing a leading role in the SPAC space over here, and a number of other mid-size dealers have been quite active also. I'm thinking about the likes of 8 Capital, the National, and so on. So they have been at the forefront of this. And what I also see now, and that is probably telling that we are pivoting into a new environment, I start to see interest emerging from the larger bank dealers. And they were the ones that, were very hesitating and reluctant after the experiences of 2015, 2016. And they are now starting to show interest. I know one of them is building a team. So I think that will help a lot also, and will continue to, enable education, comfort, and grow the business.
Mm-hmm. Okay. And I know Eric's going to pop in just a moment now, but I do want to just perhaps end off with Michael and Joe, just in terms of your experience with NEO, and anything you would recommend to viewers listening that you might do differently in terms of the process.
I'm saying this with the benefit of hindsight. It was our best decision was to list on NEO. We actually got some pushback from certain people, investors and others, and they had been a truly collaborative partner. Everything they said they would do, they've done, and they've actually done more. And I think for us, NEO is a glide path to a US listing one day. And as a senior exchange, it's something that we're very, very happy to live with the governance and the other controls that they put in place. So, top marks to them.
Okay. Joe?
Yeah, I agree. Look, I think especially again in cannabis, creativity, flexibility, and foresight, are paramount in a nascent industry, like cannabis, right? So these guys have, exactly as Michael just said, they've been wonderful partners to us. They've helped sort of hold our hand when they needed to, and then, and sort of constantly sort of been a great advisor for us, and I think that's a very key point here. So yeah, I would not change a thing in terms of what we've done, and I think it's very similar to what Michael said as well in terms of it's a senior exchange. We like the fact that our standards are a little different. That will make that add of liquidity and going into U.S. markets at some point when that's allowed. Then that'll certainly facilitate that being a little easier process. So we're very happy.
And by the way, don't buy the whole NEO doesn't trade and it's not as liquid as the CSE. It's just not true. It's absolutely not true. And we've got a year and a half to show for that. So
great, Eric. I think I'm to hand it over to you. I believe.
Brilliant. Well, I have a feeling if left to your own devices, you could be here all day. It's very clear. There's a lot of expertise in the room and information to share. I think to the audience, you've had a masterclass today across the spectrum from teams starting their journey in SPAC mode with Joe and the team at Ceres, seeing Mike Abbott and the view of Columbia Care looking back on their journey and where they are today. And Steven, obviously you and the Early Bird crew, very much instrumental in beginning to end of that journey, and obviously a partner of ours here at NEO. Sharing insights, obviously, on our view from an exchange, how that all comes together, and really being a company quarterback on the pathway to public company work, and ultimately there at the finish line to hold hands with our corporate clients as they become public companies from day one onward. Perhaps a guarantee from us, I think you'll hear another session on the topic. I think we can all agree there's a tremendous amount of interest on the street in SPACs, and still more work to do, both educational for retail investors, for institutional, and really solidify Canada's role in the SPAC industry as a whole. So I think it's safe to say you'll hear from us again on this topic. To our panelists, Mike, Joe, Steven, Jos, and of course, Catherine as our moderator, thank you for sharing your insights, your expertise. Steven, special thanks from us for the insightful keynote. You may know I'm a bit of a data-oriented individual, so seeing numbers and charts always gets me going. Lastly, again, thank you to our sponsors, Baker McKenzie, BLG, Blake's, Denton's, Goodman's, Miller Thompson, Stikeman's, Will DeBoer, and Odyssey Trust. Very grateful to have a stacked house